Hello, this is Corner Invest. Today I'll be talking about the stock market sell-off that has rebounded already and the probabilities of a recession as well as what I bought in the past week. So as you can see over here, yesterday we had a relief sort of like bounce. We bounced off this trend line over here and we're currently around 8%, 8.5% down from all-time highs. So we were previously in a correction territory and now we're out of it already. So the next test will be the 200 moving average over here, which is at around 5,700 uh, points over here. So currently, there is a 40% chance apparently that we'll be going into a recession. So JP Morgan over here is saying that we are having a 40% chance of going into a recession because of Trump's tariffs and all the reciprocal tariffs that will be coming into the country. And that will affect basically the economic spending over here that will cause GDP to drop and all that. So if you're looking at the bond market now, the bond market is not pricing in any form of recession. So the previous time when we had recession fears, the 10-year yield actually went down to around 3.6%. Now it's only at 4.2%. Of course, it's down from the highs of around 4.8 already, but it is now only down at around 4.2. I expect it to drop a lot further if we're pricing in a recession. So in the bond market, we're not pricing in a recession yet, but in the stock market, we are sort of like pricing in a recession already. The stock market has been down in a straight line for the past 2 weeks and is down around 8% already. So, of course, if we're going into a recession, then we will likely drop a lot more than just 10%. But yeah, the markets are pricing in a recession. Hopefully, we get there. And whenever you see bear pawn like this, whenever you see recession fears and all that, it is normally a dip buying opportunity. It's an opportunity for you to buy. And I think currently it is a decent buying opportunity for you to go into the markets now, and I'll be discussing what I bought in the past week or so as well. So the first company that I bought in the past week is Google. So Google is currently trading at 20 PE, 18 forward PE, and it is a company that has been growing and growing for multiple years already. It grew net income by 35% last year, grew revenue by about 14%. That is incredible revenue, organic revenue growth for a company already as big as Google. So if you look at Google's valuation, it's on the extremely low side right now. It is currently trading at a price to earnings ratio of around 20 times, which is lower than every single year apart from 2022 when there was a tech crash. So currently, Google is presenting a very good opportunity. I think it is one of the best risk to reward in terms of the stocks in the market right now. And yeah, Google is projected to grow its EPS by about 13% over the next few years. So over here, 13.5% over the next few years. And you have all your different revenue streams for Google. You have your YouTube, which is going at around 14%. You have Google Cloud, which is going at around 30%. And then you have Google Search as well, which is growing at around 10% every single year. So I think the 14%, the 13.5% here is extremely, extremely achievable. And if you have a company that is trading at 20 times of earnings, growing at around 13 to 15%, I think it is a very, very good opportunity right now, even though it has rebounded by about 1%. Next company that I bought in the past week is Amazon. So Amazon currently trading at a 35 times earnings and 31 forward earnings. So same thing, if you have to look at the P/E ratio of Amazon in the past few years, it is currently trading at one of its lowest historical valuation in terms of PE as well as I believe price to operating cash flow over here. So it's trading at 18 times of price to operating cash flow. Just a while back, it was trading at around 20 to 22 times. So I think now, if you're buying Amazon, you're getting basically a discount over here. So Amazon is a company that is growing revenue by about 10% only. But the good thing about Amazon, it is trying to shift from basically growth to profitability. So as you can see over here, net income grew by 94%. That is just incredible for any company, let alone a Max 7 company that is as big as Amazon already. So over here, based on Finviz, same thing. Amazon is projected to grow about 20% over the next 5 years. So 19.98% over the next 5 years. So similarly, similar to Google, you have a company growing at 20% over the next 5 years, trading at 35 times of earnings. I think it is fair for Amazon. It is currently trading at fair value. So if you want to start a position right now, it is a good start as well. As for my next entries for Amazon, I recently added at around $195 or $192, and my next entry that I'm looking to get in will be around $170, somewhere over here on this red line over here. And then the next entry after that will be $140, which is somewhere here. $140, and I'm loading the boat on Amazon because it is an incredible company with incredibly wide moat. You have AWS, you have your retail online businesses and all that, you have subscription business, third-party seller services and all that. And yeah, the story for Amazon is simple. All I need it to do is just to expand its margins, which it has been doing for the past few years. And if it can expand its margin by just 2%, the EPS on this company over here will just explode. Next company that I bought in the past week is S&P Global. So S&P Global is currently trading at 38 times of earnings. So why is the earnings so elevated? Why is the PE ratio so elevated? It is because they bought another company called IHS Markit around 3 years ago in 2022, and they paid around a 36 times earnings for it. That's why it's slightly elevated now. But if you were to look at S&P Global, currently it is trading at a price to free cash flow of just 26 times. And it is one of the lower ends in terms of its price to free cash flow metric over here. So what exactly does SPGI do? So S&P Global, they have two main businesses. One of it is their market intelligence and the data side business, where they have your mobility, your commodity insights as well. So those business, what they do is they just sell data. So they hold around 20% market share in each of those segments over here. It is not an extremely monopolistic one, but it is still a stable growing revenue stream where they just grow 10% every single year. Next portion is their ratings business. So for the ratings business, they're basically like a toll gate. So they hold around 45 to 50% of the entire market share. And what they do is they just rate debts. So every single company, when they want to borrow money, they need to go through S&P Global. They need to get their credit rating. They need to get their credit rating for S&P Global or Moody's or Fitch first. S&P Global is the biggest one, followed by Moody's, and then it'll be Fitch. So in the credit rating business, it's basically just a capital-light business. It doesn't require any sort of reinvestment. So if you look at the debt maturity over the next few years, the debt is projected to continue growing all the way until 2028. So 2028 will be the peak of the debt wall. So I do expect that S&P Global will continue growing its earnings in terms of the ratings business all the way until 2028, where we see the massive debt wall over there, and then it will start turning back down. So it is a cyclical business, but it's an incredible business. And Warren Buffett also owns another company called Moody's, which operates in the same field. Moody's and S&P Global, they are sort of like a duopoly. So it is an incredible business. And they have the third business as well, which is your indices business. So your Dow Jones Index, your S&P 500 Index, all of them are controlled by S&P Global. It's just a royalty business. They just get a percentage of the assets under management. And so far, over the past few years, last 2017, the assets under management, the money under the indices hasn't dropped. Meaning to say, even in downturns in 2018, 2020, as well as 2022, the assets under management in those indexes didn't drop at all. So the revenue for S&P Global, in terms of the indices, didn't really drop in those times. The last company that I bought is MSCI. So MSCI is an amazing business. They basically hold the MSCI World Index, MSCI Emerging Markets Index, MSCI China Index. So whenever you see all your different ETFs with the name MSCI, it is from this company over here. So what this company does is it licenses out its name and sort of like the ETF to all your different asset managers, and then the asset managers will basically just push it to all the consumers. And then MSCI, they don't have any risk of the money, the assets under management. All they do is they just charge a small fee on basically what the asset managers receive. So MSCI over here is an incredible business. In 2022 as well as 2018, when we had a market drawdown in those 2 years, MSCI revenue over here actually grew. So even in times of crisis, even in times when the stock market went down, MSCI's revenue grew. So when you want to look at quality companies, when you want to find quality companies, you want to find companies that can grow even when there's sort of like market downturn. And MSCI is an example of this, incredible example of this. They grew in 2022 when we had a crash, and then they grew in 2018 as well, and in 2020 as well. So for this company over here, it is currently trading at a 38 times earnings, 32 forward earnings. So of course it is not cheap, but this company has always been priced at a premium. So if you have to look at the P ratio over the past 5 years, it is currently now trading at one of the lower ends. And in terms of price to free cash flow, it is trading at 28 times. So for me, I want to buy quality compounders that can continue compounding over time. Of course, if I can get them at 20 times earnings, I'll get them. But for MSCI over here, I think paying a 28 times price to free cash flow for it is quite decent. So if you have to look at, for example, MasterCard as well, MasterCard is another quality compounder. So if you have to look at their price to earnings over the past few years, you never get them at a discount. Why? Because it is it is a quality compounder, and they're always priced at a premium. It's sort of like a premium quality discount. And if you have to look at the price to free cash flow as well, the lowest point was in 2022, which was a 31 times. And in terms of price to earnings, the lowest time was in 2022, which is a 33 times. So of course, 33 times is not very low for any company at all. But I believe paying up for quality like this is definitely worth it. As for my market outlook, I believe the market, if we ever see a recession, can fall another, I believe, 20% or so. So the lowest point will be around the 200 weekly moving average, which is where it has bounced over the past few years. And I believe if we ever go into a recession, then we will fall all the way down to the 200-week moving average. But if there is no recession, if all this is just a scare, then we will likely just move to the 100 weekly moving average over here, which is at around 522, which is around another 7% from here also. So another 7% if we don't go into a recession, if it's just a normal correction. If it's a actual recession, then it will be another 20% from here. And that is where I'll be buying. Hopefully it drops all the way down there so that we can all add to these dips.